In today's complex world, entities are exposed to financial risks arising out of different aspects of their business. Certain entities are concerned about exchange rates, certain entities are concerned about interest rates, while there are certain entities that shall be concerned about the ever-changing commodity prices. It is very natural that an entity shall like to eliminate this financial risk. And if complete elimination is not possible, at least reduce the financial risk. Any step that you are taking for the purpose of reducing this financial risk, we consider that as a hedging tool or a hedging technique. So basically an entity is having risk management tools. The purpose of this risk management tools is to reduce the financial risk. We will call them as hedging techniques or hedging tools. As far as our accounting books are considered, we are now having an item that you are using for the purpose of hedging. We will call that as the hedging instrument. You are also having an item for which you are perceiving risk. This is the item which is required to be hedged. We will consider this as the hedged item. The combined accounting of the hedged item and the hedging instrument, that is what we are going to refer as hedge accounting. Basically, the essence of hedge accounting is to consider the hedged item and the hedging instrument as a single item. You may wonder, why are we treating it as a single item? See, in most of the circumstances, what will happen is that the fair value changes in the hedged item and the fair value changes of the hedging instrument shall be opposite. In other words, if there is fair value loss for a hedged item, there shall be fair value gain for a hedging instrument. This fair value gains and fair value losses shall be offsetted against each other if we are treating the hedged item and the hedging instrument as a single item. The main benefit of hedge accounting in such a scenario shall be that a large number of line items will get adjusted against each other. So there will be fewer items to be shown in the financial statements. That's one advantage. And the second advantage is that the volatility that shall creep into our financial statements because of the fair value changes, to a large extent, that volatility shall be reduced. So let's see exactly what is the hedge accounting in greater details. So this is what we really mean by hedge accounting. We say hedge accounting is a system to represent in the financial statements the effect of an entity's risk management activities that use financial instruments to manage exposures arising from particular risks that could affect the profit or loss or maybe the other comprehensive income. For example, if an equity instrument is classified as FVOCI, then in that case, the volatility will be reduced in the OCI. Otherwise, we will be mostly dealing with items that will be affecting our profit or loss. So basically, we are referring to the entity's risk management activities. You are using financial instruments to manage these exposures. Most of these exposures will be captured in the profit and loss itself, while equity instrument classified as FVOCI is one particular item where the volatility will be captured in the OCI. Then they say, accounting for gain or loss arising from a hedged instrument, and hedging instrument is accounted in a specific manner so that measurement and recognition inconsistencies are avoided. As I said earlier, isn't it? The fair value changes in the hedged item and the fair value changes in the hedging instrument. This fair value changes most of the times will be opposite. If one is a gain, another shall be a loss, or vice versa. So why don't we just offset the two against each other by treating both of them as a single item? So a lot of measurement and recognition inconsistencies will be avoided. As you can see on the other side, use of hedge accounting is not compulsory, it is voluntary. So just think for a moment that the hedged item and the hedging instrument is not considered as a single item, then it's quite possible that when it comes to the hedging instrument, you might be recognizing the gain or loss in the P&L. But when it comes to the hedged item, you might be recognizing the fair value gains or losses in the OCI. So one item is affecting the OCI, another item is affecting the profit and loss. So this is resulting into an accounting mismatch. This is resulting into measurement and recognition inconsistency. The moment I will consider both of them to be the same, or as I said, both of them to be a single item, that will be a better word. I consider both of them to be a single item, then the fair value gain or loss will be recognized in P&L, and so for the hedged item, and so shall be the fair value gain or loss for the hedging instrument. So the accounting mismatch that otherwise would have been there, you are able to eliminate, and if not eliminate, as I have been continuously saying, at least reduce those inconsistencies. Yes, these are the terms that we have to now really understand. The item for which you are perceiving risk, this is the item which is to be hedged. We will refer this as the hedged instrument. What can be the hedged instrument? Hedged instrument can be a recognized asset. For example, I have already invested in equity shares of some company, and now I am perceiving risk with respect to that item. I have invested in a debt security, and further I am perceiving risk. So it's a recognized asset for which you are perceiving risk and for which you will take certain risk management steps. A recognized liability. I have borrowed money at a floating rate of interest, and now I am worried about the changes in the LIBOR or the changes in the MIBOR, and that is the reason I want to hedge this particular item. It can be an unrecognized firm commitment, and at the same time we can also say it can even be a highly probable forecast transaction. Either you have already entered into a contract, for example, to sell your inventory on a future date. So it's an unrecognized firm commitment. On a future date, I have already promised the other party that so and so quantity will be sold by me. But I cannot recognize that in my books right now. Right? You have committed to execute this contract on a future date. So that's the reason I cannot do any accounting right now. That's the reason I'm saying it's an unrecognized firm commitment. Or it may be a highly probable forecast transaction. I am very much of the view that on so and so date, so and so sale will take place, or on so and so date, so and so purchases will take place. So it's a highly probable forecast transaction. I have not entered into a firm commitment, but I am very much confident that so and so transaction will definitely take place. And finally, a net investment in a foreign operation. So you may have a foreign operation in form of a subsidiary or an associate or a joint venture. Even the investment that you have made in this foreign operation, even this investment in the foreign operation can also be hedged by us. So these are the different possible hedged items. Of course, one common condition for all of them, they are saying all of the above can be hedged items provided they are reliably measurable. Okay, basically a recognized asset, a recognized liability, these are definitely reliably measurable, because without their measurement they would not have been incorporated in our books. But the moment you say an unrecognized firm commitment, a highly probable forecast transaction, mainly these two items are the items where you have still not done any accounting in your books. You will do this accounting on a future date. So at what amount will they be recorded? They should be reliably measurable. Again, it is not necessary that the entire item should be a hedged item. Even a component of an item can also be a hedged item. They are saying following components of an item can be a hedged item. Which components can become hedged items? They are saying only changes in the cash flows or fair value of an item attributable to a specific risk or risks. Right? For example, I have borrowed money. Okay, we have borrowed money, and we know that this money that you have borrowed, it will be exposed to different types of risk. One can be a credit risk, another can be the interest rate risk. But I have decided that I want to do hedging only for changes that will arise because of increase in the credit risk. So it is possible that I will be hedging only for a particular specific risk. Likewise, let us say you have invested in some debt instrument of some another entity. This debt instrument is listed on a stock exchange. So there shall be fair value changes. As its price on the stock exchange keeps on fluctuating, so there shall be fair value changes. So these fair value changes are on account of the normal trading which is taking place, that is the forces of demand and supply. Similarly, changes can also take place because of fluctuations in the interest rates. Similarly, changes can also take place because of the changes in the credit risk. You may decide that you want to hedge only for a particular risk. If that is so, then that is something which is possible. So instead of hedging the entire item, instead of considering that the entire item is a hedged item, I will say that this item is a hedged item only to the extent of fluctuations in the fair value which are caused by a particular risk. Similarly, they are saying one or more selected contractual cash flow. So let us say you have invested in some financial instrument. This financial instrument is giving rise to interest. This financial instrument will also give rise to principal amount. I want to hedge only the interest, right? So you are going for a hedge for a particular contractual cash flow. This is also something which is possible under the hedge accounting system. Similarly, they are saying components of a nominal amount, that is a specified part of the amount of an item. So component of a nominal amount. So a specified part of the amount, that can also be done. For example, I may decide that out of the total cash flows, 50% of the cash flows I want to hedge. This is also something that can be done. So it is not necessary that the entire item should always be designated as a hedged item. No. Certain components of the hedged item can also be separately hedged. So hedged item is the item that you want to, whose risk you want to manage. How will you manage? You will manage through an item which will help you to reduce that particular risk. The item that will help you to reduce the risk, that is what shall be referred as the hedging instrument. This is the item used for hedging, the hedged item. Okay. Items qualified to be designated as hedging instrument. Just anything comes to your mind and you say this is a hedging instrument, that will not happen. What can work as a hedging instrument? They are saying derivatives measured at fair value through profit and loss account. Okay, so let us say you have invested in equity shares of some company. You are simultaneously buying a put option. This put option you are buying for the purpose of hedging. It is a derivative that is measured at fair value through profit and loss. I can designate that as a hedging instrument. It's very much possible for us to do so. So that is the item that we can consider over here. Or they are saying it can be non-derivative financial assets or liabilities measured at fair value through profit and loss. So your hedging instrument can be a derivative. Your hedging instrument can even be a non-derivative financial assets, right? For example, you have written an options contract. For example, let's say you have written a call option and simultaneously you are buying shares. So you write a call option. For the call option that you are writing, you are perceiving risk. So we will consider that as a hedged item. And to reduce that particular risk, I am investing in equity instruments of another entity. This equity instrument of another entity is not a derivative contract. It's a non-derivative and it is turning out to be a financial asset. I can consider that also to be a hedging instrument, provided of course I am measuring it at fair value through profit or loss. Fine. One more thing. Written options cannot be designated as hedging instruments. Remember, when you are writing an options contract, you are taking risk. And because you are taking a risk, it cannot be used as a hedging instrument. On the contrary, options written will turn out to be hedged items. These are items for which there is a risk, and hence, as a risk management tool, you will then design a hedging instrument. So options that you have written, you cannot consider them as hedging instruments. Just as we were discussing earlier, a hedged item will be designated as a hedged item either entirely or certain components. The same will happen even for a hedging instrument. Either the entire hedging instrument will be designated as a hedging instrument, or a component of it can be designated as a hedging instrument. So let us see this. They are saying a qualifying instrument should be designated as hedging instrument in its entirety except, okay, they say separating the intrinsic value and time value of an options contract and designating as the hedging instrument only the change in the intrinsic value of an option and not the change in the time value. We know in options contract, options premium will consist of time value and intrinsic value. Time value is something which will always be there. Intrinsic value may or may not be there. For example, if the options contract is out of the money, then it will have only time value. But if options contract is in the money, then it will have time value as well as intrinsic value. By chance, if the options contract is at the money, then again it will have only time value. Time value of an option is many a times referred as the cost of hedging, while the intrinsic value will go up and down, which is nothing but like the fair value changes. So if you wish, you can do this. If you are using an options contract for the purpose of hedging, options contract will be designated as a hedging instrument. Then its options premium will keep on moving up or down. Just as when we trade in shares, the share price is going up and down. Similarly, in options market, the options premium will go up and down. Depending upon the demand and supply factors, the options premium will be fluctuating. However, the fluctuation will be more for the intrinsic value. So I can designate only intrinsic value as, or we can say the changes in the intrinsic value as, the hedging instrument. Very similar to that, we can say separating the forward element and the spot element of a forward contract and designated as the hedging instrument only the change in the value of the spot element. So just as earlier we were saying that only intrinsic value will be considered, if you are entering into a forward exchange contract, you can decide that only the spot element, the changes in the spot element will be considered. Fine. Or the final possibility, a proportion of the entire hedging instrument such as 50% of the nominal amount may be designated as the hedging instrument in a hedging relationship. So you may even decide a certain proportion will be the hedging instrument. I have invested in, let us say, 1,000 shares of some company, but I have written options only for 500 shares. Understand? I have written an options contract for 500 shares. So I am worried about these 500 shares because I have a written option. I am taking risk over here. And in order to manage that particular risk, I am buying shares, but I am buying double the quantity. So I can say over here that only 50% of the shares purchased by me will work as the hedging instrument. So a certain proportion of the entire hedging instrument that can also be designated as a hedging instrument. Yeah, we would like to know what shall be the qualifying criteria for hedge accounting now. Yes. You are saying I have a hedged item. I'm saying I'm having a hedging instrument. Okay. Now, certain conditions have to be fulfilled. Then and only hedging can commence, or we can say hedge accounting can commence. They are saying a hedging relationship qualifies for hedge accounting only if all of the following criteria are met. Okay. The hedging relationship consists of eligible hedging instruments and eligible hedged items. We have already seen that what are the qualifying criteria for a hedged item. What are the items that can become a hedged item? You have to now check. Is it falling in those categories? Okay, the answer is yes. You cannot designate anything as a hedging instrument. Okay, hedging instrument can be derivative products or non-derivative products which are classified as FVTPL. So are they eligible to become a hedging instrument? We are supposed to check that. Okay. Once this has been done, then they will say, at the inception of the hedging relationship, there is a formal designation and documentation. This is very much important. It has to be properly documented that which items are considered as hedged items and which items are considered as hedging instruments. Please understand, the accounting of the hedged item and the accounting of the hedging instrument will be done slightly different from the other accounting norms which are set. in the standards relating to financial instruments. So because there is a difference, a formal designation and documentation is required. This is required for the management and this is also required for the auditor. When finally your accounts are going to get audited, the auditor will also like to know that what are the items which are hedged items and which are the items which are hedging instruments, so that the accounting carried out by the management, the accounting carried out by the accounts department can be accordingly audited, because now the hedge accounting requirements will be applicable and not the other regular accounting requirements of financial instruments. So designation and documentation, we will see that a bit later in detail. They say what is to be documented: the hedging relationship and the entity's risk management objective and strategy for undertaking the hedge. What is the hedged item? What is the hedging instrument? What exactly is the risk that you are perceiving? And what is your response to that particular risk? Right? You have done a particular transaction. This is the risk because of it. How will the risk management tool manage that particular risk? What is your objective? What is your strategy? That has to be well defined. And finally, they say the hedging relationship meets the following hedge effectiveness requirement. Your hedging should be ultimately be effective. When can we say that the hedge is effective? Okay, two things should happen. There is an economic relationship between the hedged item and the hedging instrument, right? The two of them should be related. And I'll tell you, the two of them should be related. They should have an inverse relationship or an opposite relationship. Only then the risk management tool will work. If on one item there shall be a loss, the other item should give rise to a gain. If one item is giving gain, another item should give rise to a loss, so that the fair value gains and losses can be offsetted against each other. As I told you earlier itself, that's the main essence of hedge accounting. The reason why we treat the hedged item and the hedging instrument as a single item is so that these gains and losses can be offsetted against each other. Now that will be possible only when the two of them have some economic relationship. And finally, they are saying the hedge ratio, right? They are referring to a ratio. They are saying the hedge ratio of the hedging relationship is the same as that resulting from the quantity of the hedged item that the entity actually hedges and the quantity of the hedging instrument that the entity actually uses to hedge that quantity of the hedged item. So what they are saying is that the hedge ratio should be effective. The quantity of the hedged item and the quantity of the hedging instrument should be sufficient so that hedge can be carried out effectively. As I was saying earlier also, let us say you are selling 100 options. If you are selling 100 options and you are hedging it by buying some shares, let's say you are buying some shares or some equity instrument of another entity, the quantity should be such that the hedge is effective. You are selling 100 options and you are buying 100 shares, then the hedge will be effective. But you are selling 100 options but you are buying only 10 shares, or you are selling 100 options but you are buying 1000 shares, then the hedging will be either under hedged or it may be over hedged. The hedge will then not be effective. That's the reason a proper hedge ratio should be determined so that we can decide whether the hedging will be effective or not. And yes, we were discussing that there should be a formal designation and documentation. They are saying following should be appropriately documented. Identification of the hedging instrument. Which item is your hedging instrument? Which item is your hedged item? What is the nature of the risk that you are hedging? And finally, description of how the entity will assess whether the hedging relationship meets the hedge effectiveness requirement or not. Most of the time, this is very straightforward. One has to simply check the fair value changes of the hedged item and the fair value changes of the hedging instrument. If the fair value changes are in opposite direction, then it clearly means that the hedging relationship is effective. Only thing is that you have to now check on the basis of the quantity. And if you come to the conclusion that it is effective, your formal designation and documentation will get completed. So now that you know what is hedge accounting, you know what is the kind of items which can become the hedged items, what items can become the hedging instrument, as we have already also understood that certain items, it is not necessary that all the items have to be classified as hedged item or hedging instrument in its entirety. Even components of that can also be considered to be hedged item or hedging instruments. And formally, there are certain qualification criteria which are to be fulfilled, and once proper documentation and designation has been done, we are now ready for the hedge accounting. How exactly the accounting will be carried out? The accounting to be carried out will depend upon what type of hedge are you entering into. The standards relating to financial instruments has identified three types of hedging relationships. There can be a fair value hedge, there can be a cash flow hedge, and at times there can be overlapping over here also. There are certain items which can be considered to be fair value hedge and even considered as cash flow hedge. And then yes, if you have a foreign operation, then hedge of a net investment in a foreign operation. See, in a foreign operation, you will have monetary items, non-monetary items. Monetary items will be translated at the closing rate. They will be recorded first at a rate on the transaction date, and then they will be recorded at the closing rate. So basically, these items are exposed to changes in exchange rates. So one can even have the same as a type of a hedging relationship. Okay. Fair value hedge. Let's discuss that thing. Fair value hedge. What is it? It's a hedge of the exposure to changes in the fair value. See, there are certain items that you will be designating as FVTPL. Certain items you will designate as FVOCI. There are changes in the fair values affecting my P&L. There are changes in the fair values affecting my OCI. I want to take certain steps so that the volatility of the changes in the fair value, which will affect my financial statements, is reduced. So my idea is that it is the fair value changes which are to be hedged. Actually, it is the fair value losses. Let us be very honest. If there is a fair value gain and I'm crediting the P&L, I don't have any problem with that. But if there is a fair value loss, it will be debited to my profit and loss account. This is what I want to manage. So basically, I am concerned about the fair value changes which will affect my P&L. That's where we will refer that as a fair value hedge. These changes in the fair value can be of a recognized asset, it can be of a recognized liability, unrecognized firm commitment, or a component of any such item, isn't it? We had seen it earlier also. These are nothing but your hedged items. Your hedged item can be a recognized asset, or it can be a recognized liability, or an unrecognized firm commitment, or it can be a component of any such item. Some examples are given so that you can appreciate what is a fair value hedge, right? A forecast purchase of an equity instrument that once acquired will be accounted as a FVTPL or a FVOCI. As I said, the moment I will make this investment, my P&L or the OCI will be affected by the fair value changes. I want to manage those fair value changes, especially the fair value losses. Okay. Hedges of exposure to changes in fair value of debt investment or an instrument. Instead of investing in an equity instrument of another entity, I have invested in a debt instrument of another entity. And then I classify that as FVTPL or I classify that as FVOCI. I am a bit concerned about the fair value changes and hence I want to do a hedge. This will be a fair value hedge. Or hedge of a foreign currency risk in a monetary asset or liability. But remember, you can also treat this as a cash flow hedge. Most of the times it is treated as a cash flow hedge, but fair value hedge is also possible over here. For example, you have a firm commitment of buying inventory or selling inventory, but the inventory is going to be priced in a foreign currency. In order to hedge the changes in exchange rates, you are entering into a forward exchange contract. The changes in the forward, the changes in the exchange rates, you can treat it as a fair value hedge. But as I said, most of the times we will classify that as a cash flow hedge. Why? That we will understand when we discuss about the cash flow hedge. Cash flow hedge, we say, is a hedge of the exposure to variability in cash flows. You are now more concerned about the cash flows rather than the fair value changes. Okay, again, it can be the same: recognized asset, recognized liability, highly probable forecast transaction, or a component of any such item. Okay, examples are given over here. You will understand when you will go through the examples, you will realize that you are now more concerned about the cash flow rather than the fair value changes. See, forward contract for inventory to hedge exposure to cash flows resulting from future sale of inventory. As I said, the future sale of inventory, it might be priced in a foreign currency. I am a bit concerned that when I will sell the inventory, what is the cash flow that will be generated? I am not very much concerned about the fair value change now. When I sell the inventory, what is the cash flow that I'll get? But because the cash flow is denominated probably in foreign currency, I am perceiving risk. Okay, hedge of the foreign currency risk of a firm commitment. Similarly, hedge of a foreign currency risk in a monetary asset or a liability, right? Which could also be treated as a fair value hedge. So wherever your concern is more about the cash flows, we will consider that as a cash flow hedge. For example, you have already decided that so and so amount of so and so quantity of the raw material is to be purchased, but it is to be purchased in future. You are concerned about the change in the commodity prices. What is the commodity price right now and what will be the commodity price in future? You feel that in the future the commodity price may increase. So by the time you will execute the contract and buy the raw material, the prices would have increased. You are worried about the extra cash outflow, and hence you are entering into a futures contract on the commodity exchange, right? That's where we can put this thing, a forward contract for inventory. Either you are selling the inventory or you are buying the inventory, but you are entering into a futures contract on the commodity. Here, your concern is not fair value changes. Here, your concerns are what will be my cash inflow? What shall be my cash outflow? Because these cash inflows, cash outflows will be affected by the price movements. And finally, of course, this we have already discussed earlier itself, hedge of the exposure of changes in the monetary items of a foreign operation. That's what we will consider as a hedge of a net investment in a foreign operation. So we are having three types of hedges. One hedge where you are concerned about the fair value changes which will affect my P&L or OCI. That's your fair value hedge. Another is a cash flow hedge where you are concerned about what will be the cash inflows or cash outflows in future. And you are also concerned about an investment that you have made in a foreign operation. This foreign operation may be a subsidiary or an associate or a joint venture, but we know that monetary items will be required to be translated at the closing rate, and this is what is giving rise to exchange rate differences. I want to hedge the same. Yes. Let's discuss at a greater length now the accounting of the fair value hedge. The first thing that you have to understand is that the hedging instrument is measured at fair value. And the fair value changes of the hedging instrument are recognized in OCI. If the hedged item is equity instrument classified as FVOCI, for every other item it will go to the P&L. If you have classified any equity instrument as FVOCI, then we know even when you will sell this particular item, the gain or loss will go to OCI. Even the balance, the cumulative balance of gain or loss which is in OCI, that will also remain in OCI. It cannot be recycled to the profit and loss account. So if you are having any equity instrument which you have classified as FVOCI, the fair value changes of this item will always remain in OCI. And hence, the fair value changes of the hedging instrument will be also recognized in OCI. So accounting mismatch which could have occurred, we are able to eliminate the same. For every other item, it will go to the P&L, because for the hedged item also it will go to the P&L. So for hedging instrument also, it should go to the P&L. What will happen to the hedged item? Yes, hedged item is accounted as under. See, you have classified the hedged item as amortized cost. Okay, then whatever is the fair value gain or loss in the P&L, we have to adjust it against the carrying amount of the asset. We know in case of amortized asset, we will be preparing an amortized cost schedule and we will find out what is its carrying amount. So whatever are the changes in its fair value, it should be adjusted against that carrying amount. Okay. What if it is FVOCI? If it is equity, we have already understood this. The fair value or gain or loss will be recognized in OCI. For equity, it will remain in OCI. However, if it is debt, then whatever is the cumulative gain or loss, we know ultimately it will be recycled to the P&L. But when the hedged item is a debt instrument, understand, you have classified the debt as FVOCI. If a debt is classified as FVOCI, its fair value changes are initially recognized in OCI. However, if it is a hedged item, please understand, if it is a hedged item, even if the debt instrument is classified as FVOCI, still the fair value changes will go to profit and loss account. I hope you are getting my point. You are making an investment in a bond of another entity. You are classifying that as FVOCI. Now, if you have classified as FVOCI, the fair value changes should be recognized in OCI. Ultimately, when you sell it, then the gain or loss will go to P&L, and whatever is the cumulative balance of gain or loss lying in OCI, it will be recycled to the profit and loss account. This is the normal accounting under financial instruments. But the moment the debt instrument classified as FVOCI is designated as a hedged item, now remember, if it is a hedged item, there will be another item which will be the hedging instrument. The fair value changes of the hedging instrument will go to the P&L. So now the fair value changes of the debt instrument designated as a hedged item will also go to the P&L. Both of them will be recognized in the P&L. The fair value changes both are recognized in the profit and loss account. Okay. If the hedged item is classified as FVTPL, then it's very simple. Everything will go to the profit and loss account. And if it is an unrecognized firm commitment, the fair value gain or loss shall be recognized as an asset or as a liability through profit and loss account. So if it is some firm commitment, we will start building a carrying amount of that firm commitment in our books, either as an asset or as a liability, depending upon whether there is a fair value gain or a fair value loss. Yes, let's see a question on fair value hedge, and a lot of things will become really clear. They are saying on 1st April 2021, an investment in debt instrument is purchased for rupees 10,000. It is classified as FVOCI. To protect this value, company acquires a derivative contract having initial net fair value on the same date. On 31st March 2022, after a year, okay, fair value of the debt instrument has reduced by 5,000 while fair value of the derivative has increased by 5,000. Pass the journal entry. You have invested in a debt instrument and you have classified that as FVOCI, okay, and then at the year end, the debt instrument value has reduced by 5,000. If you have classified the debt instrument as OCI, then the fair value changes should go to OCI. But they say to protect this value, okay, the first para, to protect this value, company has acquired a derivative contract. That means now this debt instrument has become the hedged item. The moment it becomes the hedged item, now the changes in its fair value will not go to the OCI. It will now go to the profit and loss account. So this fair value loss which is there for the debt instrument will be debited to the P&L, and the fair value gain which is there for the derivative item, which is your hedging instrument, that will be credited to the P&L. So 5,000 will be debited to the P&L, 5,000 will be credited to the P&L. So that's what we are doing. In hedge accounting, the hedged item and the hedging instrument is a single item. So see what has happened. There is now no no change in the P&L, right? Your profit or loss, it's becoming neutral, right? It is becoming neutral because one fair value loss is debited, another fair value gain is credited, and both of them happened in the profit and loss account itself. So if you check with the answer, the hedged item is the debt investment classified as FVOCI. The hedging instrument is the derivative instrument, isn't it? And just see the journal entries. You are first buying this financial asset. So we say it is a debt security account to bank account. And as far as the derivative is considered, the initial fair value is nil. So there is no accounting entry. Then there is a gain for the derivative. So we say derivative financial asset account debit to profit and loss account. And then we say that profit and loss account debit to the fair value, the debt security classified as FVOCI. So on one hand, there is a gain which I credit to the P&L. Another, there is a loss which I debit to the P&L. If you had not done hedge accounting, because you can say hedge accounting is optional. See, it is voluntary. If it is voluntary, I may not do hedge accounting. If you do not do hedge accounting, what will happen? Instead of profit and loss account, this will be debited to the OCI. So 5,000 will be credited to the profit and loss account, while 5,000 will be debited to the OCI. So in the current year, your profit will increase by 5,000. But in the next year or year, whenever you sell this, the cumulative loss lying in OCI will then get straight debited to the profit and loss account. This is what we are calling as volatility caused by changes in fair value. In certain years profit, in certain years loss, we want to arrest this volatility, and that's what hedge accounting will achieve. So the moment you are debiting the profit and loss account, it becomes neutral item. It becomes neutral now. My P&L is not getting affected at all. Yes, in the same question, they will put a variation at the end. They are saying, what shall be the accounting interest if it were an equity instrument classified as FVOCI? Okay. If it is an equity instrument, then the fair value changes of the equity instrument will be captured in OCI, and even the fair value changes in the derivative contract will also be captured in OCI. This is important. Okay. So this time the hedged item is the equity investment classified as a FVOCI and a derivative instrument. So equity instrument is now getting debited by its cost, no accounting entry for the derivative. And just see now, the derivative financial asset account debit to fair value hedge reserve. This fair value hedge reserve is nothing but the OCI. Okay. And for the equity security also, the fair value hedge reserve account debit, we are recognizing that in the OCI. So fair value changes of the hedged item and fair value changes of the hedging instrument, both of them will be captured in OCI. You will prepare a separate what we can say reserve. We are calling it as a fair value hedge reserve, which will become part of your other comprehensive income. If you had not followed the hedged accounting system, then whatever is this derivative financial asset, okay, this 5,000, it will get credited to the profit and loss account. A derivative instrument will be classified compulsorily as FVTPL. So changes in the fair value of the derivative will go to the P&L, while the fair value changes of the equity instrument classified as FVOCI, it would have gone to OCI. Accounting inconsistency, as you can see, one item is crediting the P&L while another item is getting debited to OCI. That's the reason I will treat the hedged item and the hedging instrument as a single item. That is the essence of the hedge accounting. And thanks to that, what will happen is this, instead of going to the P&L, will also go to OCI. So both of them will be captured in OCI. When you will see the fair value hedge reserve, fair value hedge reserve will be credited by 5,000. Fair value hedge reserve will be debited by 5,000. Basically, no change in the OCI at the end. Let us see how we can carry out the accounting of a cash flow hedge now. Okay. In cash flow hedge, we are going to prepare a cash flow hedge reserve, which will be again becoming a part of your other comprehensive income. How much amount is to be transferred to the cash flow hedge reserve? Okay. The amount to be transferred to cash flow reserve is lower off. Cumulative gain or loss of the hedging instrument from the inception of the hedge. Here we are considering hedging instrument, or present value of changes in fair value of the hedged item. Consider hedged item and consider hedging instrument. For the hedged item, what are the fair value changes? Okay, you have to work out its present value. And for the hedging instrument, what is the cumulative gain or loss? Compare the two. Lower of the two amounts will be transferred to cash flow hedge reserve. It can be a fair value gain or it can be a fair value loss, whatever. It will go to the cash flow reserve. And remember, the cash flow reserve ultimately is nothing but a part of your OCI, your other comprehensive income. Okay. Now, specifically for the hedging instrument, fair value gain or loss of the hedging instrument. Okay. To the extent it offsets the amount transferred to cash flow hedge reserve, the CHFR, it is standing for the cash flow hedge reserve, is the effective portion of the hedge. This should be recognized in OCI. To the extent it does not offset the amount transferred to the cash flow hedge reserve is ineffective portion of hedge, that should be recognized in the profit and loss account. So first find out how much is the amount which is going to be transferred to the cash flow hedge reserve. Then compare the amount transferred to the cash flow hedge reserve to the fair value gain or loss for the hedging instrument. If both the amounts are matching, understand, both the amounts are matching, then you have to transfer that to the OCI. That's what they say. To the extent it offsets the amount transferred to the cash flow hedge reserve, we will consider that as the effective portion. So the amount transferred to the cash flow hedge reserve is 50,000 and the fair value gain or loss of the hedging instrument is also 50,000. So they are offsetting each other. Then this 50,000 will be recognized in the other comprehensive income. Amount transferred to the cash flow hedge reserve is 50,000, but the fair value gain or loss of the hedging instrument is anything other than 50,000. Then either there will be under hedging or there shall be over hedging. And accordingly, the treatment is to be done. They are saying, to the extent it does not offset the amount transferred is the ineffective portion, you should recognize that in the profit and loss account. So compare the two amounts and then decide how much will go to the OCI. As I said, as long as it is offsetting the amount transferred, we will recognize that in the OCI. And whatever is the balance will be the ineffective portion. If it is ineffective, you should recognize that in the profit and loss account. So over a period of time, a balance will be built in the cash flow hedge reserve. What to do with this balance in the cash flow hedge reserve? Okay. Cash flow hedge reserve relates to a non-financial asset or liability or a forecast transaction. Then the cash flow hedge reserve will become initial cost or the carrying amount of such non-financial asset or liability of the forecast transaction. Your forecast transaction is to buy inventory on a future date. Then on a future date, you will actually buy inventory. Whatever is the balance in the cash flow hedge reserve, I will adjust it against the inventory. Why? Because inventory is nothing but a non-financial asset. You get it? So a non-financial asset, a non-financial liability of a forecast transaction, you have to adjust the balance in the cash flow hedge reserve with its carrying amount. The cash flow hedge reserve relates to other items. Cash flow hedge reserve is a gain or a loss, but if it is a loss, it is such loss that it will be recovered in the future periods. Okay. Then the balance in the cash flow hedge reserve will be amortized to the profit and loss account over the period during which the hedged expected cash flows affect the profit and loss account. So if the cash flow hedge reserve is a gain, okay, it is a gain, and we are of the view that because of this cash flow hedge that we have designed, for the next 3 years our cash flows are hedged. Okay, for the next 3 years our cash flows are hedged. Then this gain will be recognized in the P&L over a period of 3 years. Or it is a loss, but I can recover this loss in the future periods. Then the loss will be also amortized over a period of 3 years. However, cash flow hedge reserve is a loss that cannot be recovered in future periods. We are not talking about gain over here. Please understand, if cash flow hedge reserve is representing a fair value gain will be always amortized to the P&L over the hedged period. We are distinguishing between a loss. The cash flow hedge reserve is representing a loss. Can you recover this loss in future period? If the answer is yes, then amortize it to the P&L. But if you say that no, this loss cannot be recovered in future periods, then that loss will be immediately recognized in the profit and loss account. Let us see a question on cash flow hedge reserve. So a lot of things will then become clear. They are saying on 1st April 2021, an Indian company has a firm commitment for cash purchases of 10 lakh kgs of chemicals at £4 per kg from a UK company on 30th June 2021. The Indian company designates the firm commitment as a hedged item by entering into a forward contract on 1st April 2021 for ₹100 per pound, delivery on 30th June 2021. Initial fair value of the forward contract is nil. The hedge is classified as a cash flow hedge. Actual spot rate on 30th June 2021 is ₹105 per pound. Suggests suitable accounting. So you are having a firm commitment of cash purchases. On 1st April 2021, you are very much clear, right? It's a firm commitment. That means you have already communicated to the UK company. You may even have signed an agreement that I will purchase 10 lakh kgs of chemical at £4 per kg. And this will be done on 30th June 2021. Now it's very natural that if you are going to purchase this inventory is going to get affected. I mean, the purchase cost is going to get affected by the changes in the exchange rates, right? Today's exchange rate will not be the exchange rate also on 30th June 2021. There shall be a change in the exchange rates. So you are concerned about the exchange rate. I am concerned that when I will buy the inventory, what will be my ultimate purchase cost? What will be my cash outflow? So in order to protect my cash outflow from unexpected changes in exchange rates, I am entering into a forward contract. You get my point? So here we have to first identify that which is our hedged item, right? Which is our hedged item and what we are using as the hedging instrument. Okay, so this is the first thing that we have to be clear with. Your hedged item is a firm commitment. It's a firm purchase commitment. So my hedged item is my firm purchase commitment. Of course, on 30th June 2021. And what is my hedging instrument? The forward contract, right? The forward exchange contract is turning out to be my hedging instrument. So what I will have to do is, understand what I'll have to do is, I will have to capture what are the fair value change over here. I will have to capture what is the fair value change over here. Because these two fair value changes will be compared and the lower of the two will go to the cash flow hedge reserve. Here it is. I'll just clear it up so that we can then decide for this particular question. See, amount transferred to cash flow hedge reserve is lower off. So that's the calculation that we need to do over here, isn't it? So what we do here is we realize over here that your quantity is 10 lakhs and the price in the foreign currency per kg is £4. So this will turn out to be pound 40 lakhs, isn't it? Now, our forward rate, right? Our forward rate is ₹100 per pound, while the spot rate on that date is turning out to be ₹105 per pound. You are basically supposed to make a payment of 40 lakhs. if you do not enter into any hedging technique, if you are not entering into forward exchange contract, you will have to pay 105. But thanks to the forward contract, you will be paying 100. So it is the comparison of the 100 and 105 which is going to give us the fair value changes. So that is the fair value change that we are supposed to calculate. We will calculate in terms of the cash flow. You are going to purchase, so there will be a cash outflow. If you had not done any hedging, then your cash outflow will be at 105. So 105 compared with 100, the difference is 5. So this 5 rupees per pound, that is causing a fair value loss for the hedged item. But thanks to the forward contract, that same 5 rupees per pound is hedged. So that will be the fair value loss for the, fair value gain for the hedging instrument. If you see the answer, it will become very clear. This is what we are suggesting. The firm purchase commitment is your hedged item, as we discussed. The forward exchange contract is your hedging instrument. That also we have already discussed. Please understand now, the purchase cost of inventory in GBP, right, 10 lakh is the quantity. Per kg it is 4 pounds, so it turns out to be 40 lakh pounds. Forward rate is 100 rupees. Without hedging, the exchange rate applicable will be 105. So we first find the fair value loss of the hedged item. The fair value loss of the hedged item is 200 lakhs. As I said, without hedging, this inventory would have been purchased at 105. And that I am comparing with my contracted forward rate of 100. So when I compare 100 and 105, I realize that the fair value loss of the hedged item is 200 lakhs. But that very 200 lakhs is hedged. That very 200 lakhs is recovered as a fair value gain for the hedging instrument. Okay. So if you check over here now, they are saying cumulative gain or loss of the hedging instrument. Hedging instrument in our example, 200 lakhs. The fair value change in the hedged item, they are saying present value, but for simplicity, let's assume 200 lakhs is the present value itself. So lower of the two is turning out to be 200 lakhs. So the amount to be transferred to the cash flow hedge reserve is turning out to be 200 lakhs. Now, is this 200 lakhs which I am planning to transfer to the cash flow hedge reserve, is it offsetted by the fair value gain or loss of the hedging instrument? We know the fair value gain of the hedging instrument is 200 lakhs. So the amount transferred to the cash flow hedge reserve is 200 lakhs and it is offsetted by the fair value gain of the hedging instrument. In other words, this 200 lakhs will be recognized in OCI. You will create cash flow hedge reserve and this cash flow hedge reserve will be recognized in other comprehensive income. So that is what we are suggesting over here. That's our end suggestion. Amount to be transferred to the cash flow hedge reserve is 200 lakhs. Fair value gain of hedging instrument is also 200 lakhs. So it is completely offsetted. So amount transferred to the cash flow hedge reserve is an effective portion of the hedge and hence recognized in OCI. So what shall be our scheme of accounting entries? Yes, on 1st April 2021, you only have a firm commitment. You have not actually purchased. So I cannot record any accounting entry for the purchases. Similarly, you are entering into a forward contract, but the fair value of the forward contract is nil. So for that also, I cannot record any accounting entries. So no accounting entries are recorded. Okay. On 30th June 2021, we realized that there is a fair value gain and this fair value gain will be transferred to the cash flow hedge reserve, and because it is completely offsetted by the fair value changes in the hedging instrument, it will be recognized in OCI. So I say derivative financial asset account debit 200 to cash flow hedge reserve. That's nothing but OCI. On 30th June 2021, finally I am going to execute my commitment now. So I'm going to purchase the inventory. So I say purchases account debit. You can even say inventory account debit, isn't it? 40 lakh pounds at that spot rate. So spot rate is 105. So purchases are recorded at 40 to 100. However, when I will make the payment, I will execute the forward contract. Forward contract is that 100 rupees a pound. So the actual cash paid, right? It can be to cash or you can even say to bank account. The actual cash paid will be 4,000. What about the balance 200? The balance 200 is nothing but the realization of the derivative financial asset. So derivative financial asset, which earlier I had debited, now I am crediting. So purchases will be recorded at then prevailing spot rate. Payment will be done through the forward contract. So thanks to the forward contract, I am saving, right? This is nothing but the savings or the fair value gain of 200 lakhs. However, over here, as you can see, you have credited to cash flow hedge reserve. So there is a balance in cash flow hedge reserve. What to do with this balance? Okay. Here it is. Treatment of the cash flow reserve, right? They are saying cash flow hedge reserve relates to a non-financial asset or liability or a forecast transaction. That's where this particular case falls. They are saying cash flow hedge reserve becomes initial cost or carrying amount of such non-financial asset or liability or the forecast transaction. This forecast transaction is for purchases. This forecast transaction is for inventory. So the balance which is lying in the cash flow hedge reserve will be adjusted against the purchases or the inventory. So that's your final accounting entry. As you can observe over here, your final accounting entry, yes, cash flow hedge reserve account, debit 200 to purchases or inventory 200. So your inventory, which was originally recorded at 4,200, because now the inventory will be credited by 200, your eventual purchase cost becomes 4,000. Eventually it becomes 4,000. It becomes exactly equal to the cash that you had paid. The cash paid was 4,000 by us. That becomes the eventual cost of the purchases. So that's what we say, that the cash flow hedge reserve balance is adjusted against the carrying amount of the forecast transaction. And the final type of hedge, yes, the accounting of hedge of net investment in foreign operation. They are saying portion of gain or loss on the hedging instrument that is determined to be effective hedge. This is very much like the cash flow hedge treatment. If it is effective, you should recognize that in OCI. In OCI, we will create a foreign currency translation reserve. And if it is ineffective, it will go to the profit and loss account. Whenever this foreign operation is disposed of either entirely or partially, if the foreign operation is disposed of entirely, then whatever balance is there in the foreign currency translation reserve, it should be reclassified to profit or loss. In case if you are disposing of the foreign operation partially, then a proportionate amount should be transferred to profit and loss account. This will be treated as a reclassification adjustment. We know in other comprehensive income, we have two parts. We say A, not to be reclassified to the P&L, and then we say B, to be reclassified to the P&L. So this transfers to this foreign currency translation reserve will be basically shown under OCI and again under the subhead to be reclassified to the P&L. Whenever the foreign operation will be disposed of either entirely or partially, the foreign currency, the balance in the foreign currency translation reserve will be accordingly, either entirely or proportionately, will be transferred to the P&L. So ultimately from OCI, it will be recycled to the P&L, and this is what will give rise to a reclassification adjustment. I hope you find yourself now better prepared for hedge accounting.
Press the bell icon on the YouTube app and never miss another update.